All right. Hello, everybody. Welcome to Selfwealth Live, this week's edition on the 4th of March, 2025. We're already into March 2025. This is absolutely crazy. The year is going very, very quickly. Isn't it, Jace? How are you today?
G'day, Rog. I'm well. Glad to be back for another show talking about the charts because, of course, we've got plenty to talk about today. There's a lot of movement going on in the market, so I think we should have an interesting show.
There definitely is a lot of move. First of all, sorry for being a few minutes late. Once again, just put it down to technical difficulties with our systems here. But that is all good because I can still see you're all there. So welcome to the show today, everyone. Whether you're new or seasoned with us, we welcome you once again with open arms. And obviously your questions and tickers as well. So please feel free to shoot them through. It is going to be an interesting chat today because yes, there's a bit of volatility to the downside from what I can see, which is it's good to see. It's not always, it's always good to have rose glasses on and seeing going up all the time, but it's great to be in an environment where it's also going down and how we manage these things, right? So which is fantastic. If you're new, hey, what we're going to do is going to go through the Australian market in general, obviously how it looks on from a price chart perspective. We're going to go through the US markets and we're going to go through the Hong Kong markets. Then if you've got any general questions, we'll try and answer those. And then the favorite part for everyone is obviously us analyzing your tickers from a sort of technical analysis and pricing perspective as well. And that will be towards the end of the show, or the middle part towards the end of the show. All right. So before we get started, Jace, can we put our disclaimer up, please?
Absolutely. So, of course, everything we do today is general commentary only. Nothing is personal advice. And we've got this disclaimer that we put up each week, and that just goes through that. Also, I'm not part of Selfwealth. My business is Motion Trader. You can see my details at the top with licensing, etc. And then beneath there, Selfwealth, disclaimer, licensing, general commentary, all of that stuff is in there.
Fantastic. All right, Jay. So this week, let's have a look at, to start off with, the ASX market. That's continuing its way down at the moment.
Yeah, so let's get our charts up here on the screen, and first one we'll look at, as we usually do, is the ASX. So the selling in the ASX 200's moved into a second week, and of course, I think the question, which is the big focus for everyone here, is has the market made a final high or a lasting top, and how much more selling could still be in this? And I'll tell you an interesting statistic from last week. It was to do with the All Ordinaries. The All Ordinaries actually had 8 down days in a row, so an 8-day sell-off. I'll quickly just put the All Ordinaries on here because it's a little bit different. The All Ords in the ASX 200, at first glance, they look like they're kind of the same market, but there are some differences. Like there's a different combination of stocks. ASX 200 is the top 200. The All Ordinaries is the top 500. So they're close, but they're not an exact match. And the ASX 200 has really just been a little bit more resilient during this sell-off because it didn't have those 8 down days itself. You had to go to the All Ordinaries to get that. And this is the period just in here where the cursor is. That's from the 17th of Feb to the 26th of Feb. 8 down days in a row. So they are actually rare events. So the last one of these, where there was 8 days, is actually 12 days in this instance. The last time where we got at least 8 days, it was back in 2008 during the GFC. So they don't come along that often. So what does this 8-day losing streak tell us? Well, I don't think it predicts anything. We shouldn't be looking at this as a predictor of what to come. What it does demonstrate, though, is that there has been a hesitation to step up and buy this dip. And I think that's something to take notice of. I don't think it's a sell signal in itself, but it does highlight a potential near-term vulnerability. So let's just come back to the ASX 200. And so what we have here, prices have been below the 100-day moving average. So this is a 50-day moving average on the top, and beneath there we've got the 100-day moving average. So prices have been below this 100-day moving average for a bit over a week now. So that's actually the longest stint, or the longest period, below the 100-day moving average since. You've got to come back down here to late 2023 when they were below the 100-day moving average for this long. So that's a bit of a change. That I think the absence of a strong buy the dip reaction suggests that we haven't seen the low yet. Prices are still testing lower, and I don't think we should be surprised if we see them go a bit lower still. Keep an eye on this support. See this blue horizontal line comes in around 8,100. Keep an eye on that. This has been a technically active region for a while, and you can see all the tests of this region over the last year. Firstly as resistance, and then as support. So I think I won't be surprised to see this come into play again. Now, you might remember last week we were discussing how tops form, and essentially I was saying that they take time to develop, and one down week, or now we could say 2 or 3 down weeks, doesn't signal a top. So nothing has changed from that perspective. We still only have a short period of market weakness from an all-time high. So I think it's too early to say the bull market is over. In fact, the odds, when I look at this, I think the odds still favour that we ultimately get a bullish resolution from this. But we don't know. We just have to see how things play out. But this time, it's just so close to an all-time high. It's too early. It's too early to say that that's the end of it. But we do have some cautionary signs. So they are, one, we've got the lack of buying of the dip on the way down, and also prices have been holding below the 100-day moving average. So they're classic signs for caution. I think the next rebound will tell us a lot. Do we get a strong rally where it really shows it's a real sign that the buyers are stepping up and really starting to come in and try and get stocks at lower levels? Or do prices just struggle to make headway and they just get stuck below these moving averages, which then becomes a point of vulnerability and suggests weak demand and selling into the rally? We need to see which one we get when we get the next rebound. And there will be a rebound. It's just a matter of when it is and from what level. I think the way to play this is to be guided by the price action. At this point, this trend remains in place. We've been below the moving averages before. It's nothing new within an uptrend. We get these periodic excursions below the 100-day moving average. So from that point, I think the trend remains up, but it is under pressure. There's no doubt about that. For me, that means maintaining long exposure where it's warranted, because I don't want to be selling every time there's a pullback. How many people have predicted a bear market all the way up? You get all these highs and people say, yep, that's it, we're going into a bear market. It doesn't happen. Uptrends can be enduring, and they can have these sell-offs and then they're back. So at this point, I think it means, for me, it means staying with my best stocks. I want to stay with my good stocks for as long as possible, but I'm also reducing risk. So I've been exiting stocks that as they hit their exit levels. I'm also happy to be holding a bit extra cash, raise a bit of extra cash by selling stocks as they come back to their exits, until we get a clearer picture of how this is all shaping up. Rog, I think there are many ways this could play out. For example, we could get a period, a multi-month period of sideways price action. That's just one. That's not a prediction of that. It's just an example of one type of scenario that could play out. And then that could lead to new highs later in the year. So, as I say, I think it's too early to say the bull market's over. My number one strategy for these periods is to use those wide calculated trailing stops. So as I was saying, I want to give the uptrend, I want to give my best stocks every chance to resolve to the upside. I want to give them plenty of room to move about, but I also want to have a clear-cut exit strategy should prices continue to deteriorate, and I've got my way out. It's not holding and hoping. It's holding until the point of exit and then raising more cash.
Yeah. Quick question around obviously reserving capital and using stop losses, Jay. So I don't know about you, but I'm seeing some of my my holdings hitting their, going closer towards their stop loss is a lot quicker at the moment, right? So, are you a lot more attentive on your portfolio than what you normally would be? Are you putting, more alerts in? Are you, how are you managing this slightly different to when we were on a bull run?
Yeah, I am, and I just did that today. There was one of my best performing stocks hit its trailing stop today, and GTK Gentrack. I've held it for over a year, and it's up several 100%. And I knew it was getting close to the stop. I've been monitoring it for the last week for this very reason. Often I don't. I just see what hits the exits through the day, and I'll look after it later on. I'm not too bothered. But when we're in this period of heightened uncertainty, of greater volatility, I will pay closer attention to what's getting near the stops, particularly if it's a larger position, and then I can, rather than wait to get the news after the close when I run all the data through the system, I'll be able to close it out in real time, and that's what I did. It's a great position, but I've just so basically it's a sell off, but I'm using the sell off as creating a take profit event in a large profit. But I think being vigilant is warranted in these periods. What can happen is a stock can trigger an exit early in the day and then keep selling off during the day and move. They can move a long way during these periods, particularly if something comes out from the company. And I just don't want that happening I don't want it happening with any position, let alone a large position. So that's why I think it's worth being on top of where your exits are during these times.
Yeah, like you, I'm certainly a lot more attentive of when price is getting close towards my exits. I'm putting alerts on TradingView. The stop loss functionality is there on the Selfwealth platform, for instance, but you just got to be careful with that as well, because if you set a limit price with the stop loss functionality and all of a sudden the price gaps down over the limit, your stop loss is not going to save you, right? It's because you've limited the price higher than what the actual price has become at market, right? So just got to be wary of these things, but yeah, be a lot more attentive of your stocks going towards those exit levels, right? So
that's a good point, Rog, about like limits. When people set a stop loss and they put a limit in there, it's like there's a good reason for having a limit, particularly if it's a less liquid stock. If you just have an at market sell, you can get an awful fill, particularly when the market's coming off. So there's a good reason for having a limit. But if your stock isn't sold before that limit is passed, then you're left holding stock. So I think you've got to you can't. I think it's best not to be just set things on autopilot during these periods. You've got to monitor. There's a bit of work to be done at times, and this is one of those times where when in that general upward trending phase, there's less things to do, but then we get a bit busier when you go through these periods where the market pulls back, and we never know whether a pullback is going to be short-term, temporary, or more longer lasting. So we've got to keep monitoring, got to keep responding to the price action as it unfolds.
Yeah, exactly. All right. Okay, let's have a look at the US markets then.
Okay, so over to the S&P 500, and there's been some significant price action over the last couple of weeks, and unfortunately, there's a negative tilt to that price action. So the key feature we've been tracking on the chart had been this trading range developed over a three-week period. Nice rally off the January low into the trading range. Had a breakout from there a couple of weeks back. And often these are holding patterns before higher prices. So it looked like that breakout was going to lead to higher prices, but as we know, it failed. There wasn't that follow-on buying, and instead prices have reversed over the last couple of weeks and continue to come back to where we are now. And so this leaves behind that false break. We spoke about that last week. So the price action over the last few days has continued to be weak. There was an attempt to buy the dip on Monday. You can see the price. You can see just where the cursor is. Prices got to a new low on Monday, and then they closed up near their high on Actually, that would have been Friday. I've got to think back. It's a day behind when we look at the US market. So it's Friday's price action. And then on Monday in the US, the prices opened at a new high, and then that rally was just sold into, and it closed down near the lows. So this suggests to me there's more near-term downside where the rallies are currently being sold, not being bought. Now, this doesn't mean the overall upward trend is over. This has been an enduring upward trend going back to October 2023. There have been these scary periods before, which the market's recovered from. That doesn't mean that this one's going to be quickly recovered and up to new highs, but we don't know. There's no crystal ball here. There's no predicting. It's just about preparing. That's what we do when we look at these charts. We don't predict what's going to happen, where the things will be next month. It's preparing for what could happen. This is what trailing stops are all about, and buying breakouts. You're responding to the market as it's doing things, and you're then having a plan around that price action. So, as we discussed last week, big tops, they take time to develop. S&P 500, well, it was an all-time high just 8 trading days ago. So I think we need to maintain some perspective. It's a rare occasion where the market goes from an all-time high to a bear market in 8 days. COVID was an example where it can happen, but that was probably more of an aberration than a setup that we often see. More often than not, topping phases take time. But the price action, I think it certainly is cause for caution and maybe some scaling back of a bit of risk. And that's what I've done. I've done that in the US market over the last couple of weeks. I was telling you about that last week, how I'd sold an S&P 500 position. I also sold a small cap position. So I've been de-risking. Haven't been exiting the market. I've just been de-risking. You could say that it's a bit like trimming the sails. I'm still on the boat. I'm still out there, but I've just trimmed the sails back a bit. At this stage, this is only a pullback. There hasn't been a structural change to the price action. The moving averages are generally still rising, and prices only just recently dipped beneath the moving averages, but we wouldn't really call this a structural change at this point. It's also interesting to note there's been 2 false breaks just within a month. So we had the first false break to the downside, that was in early January. Then we had a false break to the upside in February. So false breaks in either direction, I think that's a sign that the market really lacks conviction in either direction. And maybe that suggests a multi-month period of messy price action where conditions just get harder. And I think this is another reason to maybe consider de-risking while this heightened uncertainty plays itself out. So, Rog, clear trending markets, they will return, but of course we don't know when. These periods that we're going through now, where they're choppy and they're volatile, that's part of the stock market as well. We all like these smooth upward trending phases, but that's just one part of the cycle. Another part of the cycle is we get choppy messiness. That's currently where we are. And this is where our strategy for protecting capital comes into play. It's all about, for me at least, it's all about minimizing losses when things get more difficult. So having a bit more cash during the difficult periods, and then patiently waiting for the next round of bullish signals, because they will come. It's a matter of when. So let's make sure we've got plenty of protected capital. And so when that nice trending phase does come, we get good breakouts. We're ready to play those breakouts, and we've got the capital, and we're mentally in the game. We haven't been beaten up too much during the more difficult times, and we're ready to play.
Yeah, good points. Definitely don't want to be beaten up like a lot of people who wouldn't really think of this or look at this, and they just look at their portfolios, and it's not looking good at the moment. But all right, let's get on to the Hong Kong one. Even that's starting to take a turn, and that's been the performer over the last few weeks, hasn't it? So
yeah, so we're starting to see that pullback in the Hang Seng. And this comes after prices got considerably stretched above these moving averages. So I've spoken about the last couple of weeks. I was saying, look, prices are getting stretched, and they kept stretching. but at some point gravity kicks in and prices do come back towards those averages. I think maybe the Hang Seng could be in for several weeks of consolidation. It's had a big run off that low in January. And what'll be interesting here is, does it hold on? Does it do a good job of holding on to much of these gains, or does it give it all back? Particularly, we've been seeing the Chinese market do that. It rallies and it gives it all back. So that's a telltale sign of whether there's buying at the dip. Is the pullback going to be supported? Overall, I think the technical backdrop here is positive. Hang Seng has got a series of higher lows, so you can just see, you can go all the way back to 24, and you can generally see we've got a rising lows, and of course we've also got the rising highs. So that's the building blocks of an upward trending phase. If I was long this, I'd be happy to stay that way and see how the pullback develops, and it could provide the next entry opportunity. Jumping to China quickly, this remains out of sync with the Hang Seng. It's just not really getting that momentum. Prices are now above the moving averages. They're pulling back towards them now. The key here really is, can this Chinese market get some upward momentum going? And really we're looking for it to break that series of, it's got a series of lower lows. It just really can't break it. Can it get a punch to the upside and break that series of lower lows? I think one to keep an eye on, but I'd like to see a clearer sign of upward momentum before considering entry point.
All right. So there are our markets, and we've got a couple of great questions actually. And I think the first one here is something that's on my mind sometimes. Thoughts on setting, one from Talwin, thoughts on setting tighter stop losses on stocks that have given 100% plus returns in these volatile times?
I get this sort of question a bit. It all comes, like, people want to really be protective of their capital, of their gains. I understand that, but the problem with setting a tighter stop loss, if you've got a stock which is up 100%, first question, let's put an example up. Let's see if we can talk through something. We'll use GTK because it comes to mind. I've just been talking about it. So, yeah, lovely uptrend. Now, let's go. So the motion trader signal was back down here. Where's 100%? Okay, so let's that's 170%. Well, look, there's 100% there. So there's the motion trader signal. The stock's up 100%. So, how have you got to 100% in the first place? You've got there because you've resisted the urge to take an early profit. You've resisted the urge to set a tight stop loss. So there's been volatility in this stock. There's a 22% pullback. So if you've been running a 10% stop loss, you're not going to get 100% in the first place because you've been knocked out during these bouts of volatility. So now we're up 100%. We say, okay, we want to protect that. Let's move our stop up for 10%. It keeps you in the rally so far. But what happens here? What's that? There's a 12% pullback. So if you tighten your stop to 10%, maybe you've been stopped out there. Or if you've managed to avoid that one, here's another pullback. What's this one? There's 15%. So if this period didn't get you out, maybe this 15% pullback has pulled you out because you've tightened your stop to protect that profit. So you still make a great profit, but it gets harder to see off these pullbacks, as we know. This stock continues trending up, and these are pretty mild pullbacks as well. GTK, this was a really smooth upward trend. Many upward trends aren't so forgiving, and you get those 20, 25, even 30% pullbacks. So if you're up, say you're up 200%, and you take it up to 15% for your stop loss, and you get a 20% pullback, you're out. The stock could then double again. So rather than use a close trailing, rather than tightening the trailing stop, I'd rather take a partial profit. or and this is what I do occasionally. If I've got a really big gain, I'll say, look, I'm going to sell a third. It could be sell a quarter, sell a fifth, sell a half, whatever it may be, whatever anyone wants to do. That could be the rule. If a stock is up 200%, sell a third. And then if it's up 300%, sell another third. Just examples. These are just examples of how you could play it. I'd probably rather do that than set a 10% trailing stop. I think I'd just find that frustrating because I know what's going to happen. I know there's going to be a 10% give back, and there's a good chance that the trend will continue. So I think if we want to stay on these trends, it's wide trailing stops. If you're uncomfortable with the size of the position because it's increased so much, sell a third. You could say, look, sell a third if it comes back by 10%, use a 10%, tighten the trailing stop to 15% or 10% of your must for a portion of the stake, but then leave the balance running with a wider stop. All these different ways we can manage. There's no single right or wrong, but always, I think, for me, I always try to remember, how did I get myself in this position of having a 200% or a 300% gain, whatever it might be? And the answer is, I got myself in that position because I let a profitable trade run and I gave it lots of room to move around. That is critical, giving it lots of room to move around, because you just won't be in that position if you're clinging to your open equity too tightly. And I think it's one of the biggest costs a lot of people have in their trading, is that they cling onto that open equity too tightly, and they get knocked out on a relatively modest pullback. So yeah, something to really give consideration to.
Yeah, good point. And I think in general as well, something that I've been thinking about is that when we talk about this a lot, it's kind of, we relate it to the 80-20 rule. The more you take your profits quicker, the more you're going to lose that opportunity to cover the costs of your losses, right? Because you're going to have 80% of your portfolio losing, that 20% hopefully make up for your losses, right? So if you take them a lot earlier, you're going to have a lot less opportunity to cover your losses, right? So
I really don't like capping my upside potential, because I know it's my big wins which make my portfolio work. Because I've got lots of small losses, I've got to cover those. I'll have a fair number of modest profits as well, so they kind of start to net one another out to an extent. But it's big gains which do the real heavy lifting, and they're, as you say, Ross, there's going to be fewer of them. So I want to, when I get them, I want to really maximise them as much as I can, and I don't want to do stuff that, like 100% sounds great, and it is, but 100% stock can go a lot further. So I don't see 100% go, great, okay, work here is done. It's like if I'm GTK, this stock here turned out to be a 400% or something gain. 100%, it had a lot more work to do. I don't want to cut that potential short by being too protective of what seems like a great gain, what is a great gain, but knowing there could be a whole lot more in it. So this is a thing so many people struggle with emotionally. It's like holding on to those early gains, or holding what seems to be a good profit, holding on too tight, and not being able to maximise the full potential of their best stocks.
Yeah. All right. This probably leads on to the next question quite nicely. So by saying de-risking, Jason, do you mean selling 100% of your few holdings, or part percentage of many holdings?
De-risking in that, well, I had it's about selling things which hit their exits. Like one thing I sold, I had an S&P 500 position, and this was a week ago. So this was that's Friday in the US. I had this. I spoke about this in my weekly Friday strategy session. I said, I'm watching just in case we get a false break, and that would be a sign that this isn't quite right. So had a look when I woke up Saturday morning. The US market still had like half an hour of trade. saw we had a false break, so I just sold the whole lot. I sold an ETF S&P 500 position, so there's some de-risking. And I had an ASX listed global small cap ETF, which was, here's the ticker code for the ETF I had. It's a Van Eck small cap, and it's mostly based around US holdings. And so when the US market, when we're getting that turnaround US stocks, I sold it the next day. So where's the Monday? So I sold it on the open on the Monday. It's probably still around about where I sold it. But again, I've just moved out of that part of the market. So de-risk, more cash. GTK, which we were just talking about. So it's hit a trailing stop. So that's sold that earlier on today, round about current levels. So there's some more de-risking because more cash. So it's not like I'm just going through my portfolio and just saying, okay, I'm going to sell a third of all my stocks. It's like selling non-core holdings, which or like in the case of the S&P 500 ETF and the small cap ETF, they're just like add-ons to my stock holding. They're not my individual stocks, where I've got my calculated trailing stops for. The reason for buying them wasn't valid anymore, so I've just sold them, raised cash. So that's how I've been de-risking. Then like stocks like GTK's hit a trailing stop, I sell it. I'm not immediately going to rotate that money back into the market into a new stock. I just let it sit in cash for a little while. And there are other stocks like GTK, but maybe not. Some have been losses, some have been small profits. Sell them. Money goes into the bank, into the cash account. Just build that pool of cash. And as I was saying during when we were talking about stuff earlier on, it's like trending periods will return. It's just a matter of patiently waiting for things to settle down, for the chop to subside and get some good bullish breakouts happening, whether that happens in the near term or whether it takes several months or whatever. It's I'll have that cash ready and waiting when the good signals, what appears to be good signals, start to come back in. So yeah, for me, that's what de-risking means. Doesn't mean I'm going out, oh look, we've had a down day, I better sell half my portfolio. No, because I've got plenty of stocks. Like here's a stock that comes to mind in my portfolio. Emerald Resources. I've had it for a long time. It's a gold stock. I've ridden this lovely uptrend. I'm not saying, oh, look, I've had a few down days, let's go and sell half of Emerald Resources. Why would I do that? The uptrend's still in place. I've got a wide trailing stop. So I'm not touching my good stocks, my really profitable stocks, unless there's a reason why it's just become too big a holding and I would just want to scale out of it. But there's none of my portfolio I'm doing that at the moment. I'm letting my good stocks run, wide trailing stop, and raising cash when stocks do hit their exit points or it's an ETF exposure. I'm happy to just shut down for the time being.
All right, some great points there. Okay, let's just have a pause. Don't forget to like and subscribe on our video and write any comments after the video. If obviously we're on live chat at the moment, we'd really appreciate that. And if you do have any questions for following weeks, yeah, feel free to put it in the comments as well, and we'll be reading those. You're absolutely right, Talwyn. While we won't go into the UK and European markets, it does seem like there's a bit more action to the positive or the bullish side on the European, the German DAX, and
just on that, Rich, I will quickly just look at that because I looked at this morning. That's just made. This is the Euro Stocks 50, and that just made a new high overnight. So it's interesting. We're seeing this weakness in the US market, and the Aussie market, as it often does, is following the US market. But it's not. This isn't a global theme of equity sell-off, because when you look at the European markets, they're not really following that script. We had a big breakout. This is something I spoke about in my weekly strategy sessions back in January, and this upward trend has continued. So there's more to the global markets, believe it or not, than Nvidia and the US. It's like, of course, they're a big part of it, and it's a big focus point. But this isn't a global pullback in equities. So it's just another piece of the the puzzle and the smoke that makes it, it makes things difficult to try and put all these pieces together. So again, it's why I'm not out there just selling the portfolio out. It's like, well, okay, let's just keep this in perspective. At this stage, we've got a pullback. We've got an exit plan around, for me at least, I've got a calculated exit plan around my stocks. And if the market keeps pulling back, well, I'll pull the trigger and exit stocks as they need to be exited. But if they don't, let's see how this plays out. It could all settle down, and within 4 months, we're back at all-time highs. And that's not a prediction. I don't know. But it's well within the realms of how markets work. Everyone gets anxious and nervous, and they sell stuff, and then the market stabilizes and moves up again. We've seen it so many times in the past. So I think it's going to be part of our thinking that could happen. So rather than just run out there and say sell, it's like, well, let's just keep a cool head and follow our plan. The plan that we put together when we were clear-headed and the markets were okay and there was nothing to get worked up about. So now we've got a pullback. Let's look at our plan, look at the rules, and just treat it objectively and calmly and clinically.
Some good tips there, I think. Market won't care what you do, so keep cool and and just
care less.
Exactly. So, all right. Thanks for those great questions, and thanks for bringing up those European markets. Because at the end of the day, it is a good point, right? It is not a global thing, right? Other markets are thriving, while the US and Australia, or Asia, so to speak, bar Hong Kong, is sort of coming down a little bit, but it's not global, right? So, good point. All right. So let's get on some tickers here, Jace. Let's start off with Ben's on Zip.
Okay, so let's have a look at this. Well, the structure's starting to change here. We've now got the moving averages rolling over and the rally's being sold. So it's changed from buy the dip to sell the rally. Not a stock I'd be buying at this point. It's once this structure changes for me, it's like it's step aside and see what happens. Like assuming I'd be using a calculated trailing stop as well. If my stop if it's still above my stop, even though the structure's changed, I'll use my calculated trailing stop. That's my exit point. I don't think Zip's a motion trader stock. I don't think it's left the motion trader portfolio yet, but the trailing stop is probably coming into sight. So if I was in it and it was above my trailing stop, I'd stay in it, but I wouldn't be buying this dip. The time to buy the dip is when you get the pullbacks to moving averages, which are generally rising. When that's buy the dip. When you get prices falling, consolidating below averages, and then selling again, that's sell the rally. So it's a sign of vulnerability and I think a sign for caution.
All right. Next one is NRW. Sorry.
Did I get that right? NRW.
Yes, you did. NRW. Nothing in the US. We'll maybe get some clarity on that one, Lloyd. Sorry, NWH. So it's the next comment along. So I think he's meant NWH. That's the one.
Yeah, and like here, this is so we're just talking about this change in the structure. So we could just go back, look at it like here. If you asked me a couple of days ago, I would have said exactly what I said about Zip. The structure's changing. Moving averages are crossing. We're consolidating below the moving averages. It opens a window of vulnerability. And sure enough, look what's happened. It's not a dip I want to buy. If it's a stock I had, it's a stock I'd be exiting. I don't want to play in this situation, and this is a really tricky time for a lot of people because I say, look, I'll hold on for a bit longer, and if it rallies back to where it sort of broke down from a few days ago, I'll sell there. And I understand why people do that because they don't want to lock in a loss and they want to hold in the hope that it's going to come back. The problem is, like, I think the question we've got to ask ourselves is, what if it doesn't come back? What if this has got more downside to come? What if in a few months we're down here at $2.20, and you're still saying, look, but if it just got back to there, I would have sold. Now, if it gets back to maybe where it is now, then I'll sell, and you end up chasing your tail. Some of these stocks never recover. Many do. Many stocks recover, but some don't. We just don't know which ones are the ones that won't recover, or how deep or how long the corrections will last. So for me, it's an exit. I would have had a trailing stop in place. It would have triggered during this selling phase and over the last couple of days. Even if I had to take a little bit of an extra loss, it's not a stock I want to hold. Not in this environment either. Certainly not a buy. For me, it's one I've got to protect capital on, and we can always put capital into another stock at another time, but we've got to have capital to do it. If we tie up capital in stocks which aren't working, and we let those stocks which aren't working continue to unravel, it's like we just deplete our pool of capital, and that makes it hard for us to move forward in a constructive way. It's like losses are just going to be a part of it. Unpleasant losses are going to be part of the stock market. That's why I always say many relatively small trades, not a few big ones. So if I had a 40 stock portfolio and NWH was one of them, it's like, well, that's annoying to see it gap lower, but hey, it's 1/40th of my portfolio. Percentage wise, it's not that big a deal. But if I've got 3 stocks and this is one of them, well then it really starts to become a lot more emotional, because percentages get a lot bigger. So that's the way I'd be dealing with stocks like this now.
All right, fantastic. Next one. Well, that one's not fantastic, but the next one, let's have a look, is RDY. There's this one.
Yeah, well, it's had a brief. So it's had this. This is one which has been below moving averages for a while. There was this brief period during February. Got back above the moving averages, consolidated along the moving averages. So this was looking encouraging, and then we got this break higher. So at this point, I think this was a break which was valid and worth considering, worth going with. But some breaks are going to fail, and this one failed soon after, and that sort of like really made a mess of the setup. It voided the setup really, and then it's about protecting capital. So if I'd bought on this breakout, I'd just close it out and just say, look, it hasn't worked. My reasoning for buying it, and I don't know the reasoning why our viewers bought this stock. I'm just looking at it from my perspective. I could well have bought the stock at this point here in February, and had I done that, I'd be looking at it here going, my reason for buying, like this breakout off the moving averages has now failed, so my reason for getting in is now invalid. So I'll just close it out, move the capital, de-risk my portfolio by moving on a stock which hasn't been playing out, rather than continue holding it in the hope that it's going to go back. In this environment, I think the odds favour it not going back there anytime soon. It's a stock I'd probably prefer just to use as another de-risking play. Move that money to cash. I want to hold relatively strong stocks. I want to hold stocks which are doing a good job of holding their uptrends and just having modest pullbacks. I want to get rid of stocks which are where they've got failed breakouts and having abrupt moves to the downside.
All right, next one along is SKS.
Now I've got this one, and one of those ones I'm watching closely. It's one of my largest positions, and it's like, is this the start of something which is going to turn into a larger pullback? It certainly has that potential to do so, although it has been in this position a couple of other times in the last few months. I actually scaled out of this position back in September, and I did that because I had a big gain. I was already up. I can't remember exactly where I got in, but it's a motion trader signal from probably back around December 23. I was probably up around 400 and something percent. And we started getting this volatility around September last year. And I thought, look, I'm going to sell a third. So I sold out of a third, stock fell a bit more, stabilised, started going back up. And that's fine. I don't regret that sale at all. It was a de-risking strategy. It's not about trying to make every possible dollar down to the last possible cent from each trade. It's about trying to maximise my gain whilst being able to manage risk. So it's two sides to it. It's not just maximise profit, it's also manage risk. So part of my risk management was de-risking when I had a 400% gain by selling a third. So I'm not selling any more of that position now because I've already done. So I think I'll end up waiting for the trailing stop to hit, whether that be in the near term or whether it stabilises here and pushes higher. I don't know, but I'm holding at this point. I'm happy holding at this point. I'm not buying the dip here, even if I didn't have any. I don't want to buy the dip here. Not in this current environment. So yeah, that's what I'm doing. I've got my calculated trailing stop, and I'll continue holding till it's hit.
All right. Next one's PRN.
Well, we get these situations where, fortunately, we don't get too many of them. We get stocks and nice upward trends, and what appears to be a routine consolidation, you get this gap lower. And there has been a bit of this over the last 2-3 weeks. Either side, it's like you've got stocks which have gapped down 20% and stocks which have gapped higher 20%. As we've gone through this earnings period where all these results have been coming out, and that's coincided with a period of volatility in the market, where the market's been quick to knock down stocks which have missed expectations and quickly buy those that have exceeded. I'm glad the market isn't this erratic at most times. I would have, if I had this, I probably would have exited. I'd say this pullback would have been enough to trigger my trailing stop, and I probably would have sold it the next day on the rebound and gone, okay, look, I've got a bit of a better level because it had this snapback rally. And if I was still holding it, I'd probably be inclined just to take this rebound as a bonus. It is encouraging that we've got that rebound. It does show there has been interest in buying the dip, but I think it does do quite a bit of technical damage. It's a close call for me, this one. Whether in more normal conditions, maybe I'd be inclined to just see if this strong rebound can continue to come back a bit more. But I think there's been enough technical damage that it does at least sever the upward trend for the time being. It's not a stock I'd want to buy at this point, and if I had it, I'd be considering whether I wanted to use this rebound as an exit point, a better exit point than what could have been on this sharp down day.
All right, the last one for Tone is ACF.
Again, it's a stock which looked to be gaining that upward momentum, and we've had that quick reversal. This is still above. It is a motion trader stock, and I know it's still above the. I'm pretty sure, at least. Yeah, it's still above a motion trader trailing stop. So if this was one of my motion trader signals for my portfolio that I'd acted on, I'd continue holding them in the portfolio. It would I'd be either using the stop loss, which is going to be lower, or my time exit, which is still going to have a little bit of it's going to still have probably a couple of months to run, because this would have been my breakout in late January that it would have followed. If I wanted to be more aggressive and just wanted to clean up stocks, which if I wanted to de-risk and I was looking at clearing out some of my weaker stocks, this would be a candidate for a stock I would just clear out, because I'd say, look, I've bought in on the breakout. I'm down. What is it like? Say that's my entry. Roughly, I'm down 8% or something. I just take a small loss on that and just put a bit of extra money in cash, because it's lost its immediate momentum. So there doesn't seem to be a near-term need to be in it. If everything stabilises and the market settles down and it starts to move higher, well, I can always get back in at a later stage. But if the markets get more volatile and this continues to give back ground, well, I've got a bit more money in cash. That's probably the way I would look at a stock like this. But I wouldn't be looking at buying opportunities. There's probably going to be a few stocks that I'm looking to buy just at this point, just this week, maybe next week. Let's just see how the price action of the market plays out in terms of buying. But it's one of those stocks, this one here, one I could consider just as getting rid of some of my weaker stocks that aren't structurally strong. This could be a candidate.
All right. I don't know. Hopefully we'll get something that looks good very soon. But let's have a look at SVR. Maybe not these times.
Well, it's just one of those times. I don't think we're going to be seeing a lot of strong breakouts. And this is part of the market. This isn't an unusual period. Markets have these times where there's shakeouts. I've got this stock, and I'm continuing to hold it. I've got no problem holding it at this point. It was starting to become vulnerable, spending this time around about kind of getting to the underside of these moving averages. Good results came out a week ago. It shot the price up. Now it's pulling back to the averages. So I'm happy to hold it. I've got my stop loss in place. If it comes back to that, I'm out. But if it holds in, look, I'm happy to stay in it. There is like we could still argue that this is still like a rounding, basing type of pattern, which is starting to lift off. But it's hard to see too many stocks running away on the upside until the market stabilises. So that's why I don't think there's a great hurry to charge in and do a lot. If this was a more benign market where it was just treading sideways or gradually rising, you could say, look, maybe this is a buy. You buy back on the moving averages, just put a stop loss below these recent lows, and that could be a play. But that's not the environment we currently have. We have an environment where further losses look like a decent chance in the broader market. So I'm holding this one. I'm happy to keep holding it, but I'll be watching my exit level.
All right. Next one along is thoughts on gold and EVN, please.
Okay, let's start with gold. So I talk about this in my weekly strategy sessions each week, and it's a case that like we've had this smooth upward trend without there hasn't been much volatility at all, and prices have become stretched above their 50-day moving average, and so I'll just show you an indicator which I've shown my strategy session members over the last few weeks. You can see that this indicator here, it shows the percentage above the 50-day moving average. And when we get to it's around 7%, run a line across from 7%. And I've gone back further in the strategy session videos. I won't do that today. But when gold gets around 7% above its 50-day moving average, it tends to be a point where the trend's close to pausing. And so this is something I've been saying for the last couple of weeks. And sure enough, we've got this pause starting to develop now. Prices pulling back to the averages. I think this consolidation probably has further to run. Maybe some more time, maybe some more price. I like the trend in gold. I think the overall trend remains up. Nothing's changed from the overall trend, but just from a timing perspective, I think it needs a bit of time for some consolidation. And look at these a couple of previous times where the market got stretched above the averages. So that was before the October consolidation and before the April consolidation. So I think it might take a bit of time to play out. I got plenty of gold exposure. I'm happy holding it. I'm not taking profits in any of my gold stocks. EVN, Evolution Mining, trends nicely up. It has come again a bit stretched above the moving averages, so a bit of consolidation. Averages catch up, but at this point, like we've got these previous highs, so it's pausing near the previous highs as well. So there's some overhead resistance, and I've got some of this. I've had some of this for a long time. I'm happy to keep holding it. The trend is up. Give it lots of room to move around. That's my approach. I'd have my stop well below the 100-day moving average. So I give it lots of room to move. I think we've talked about this quite a bit already. It's important, I think, to give these bigger trends, give a trend, lots of room to move around if you want to stay on it for a potentially larger move. Because, you can see there's plenty of noise in these gold trends, and they when they pull back, they can pull back hard, they can scare people jump out, and then the trend can re-engage. So at this point, trend remains up.
All right, next one along is bot.
Yeah, another one of these situations where we've gone from, so it looks like it was, trading at an all-time high, and then with barely a hint of trouble, it's quickly pulled back to below the 100-day moving average. If I had this, I'd continue holding it. I'd have my wide trailing stop, which would be still giving it room to move around. We have seen this in the past. From an all-time high, it's pulled back and to the averages and then gone below the moving averages, stabilised and re-engaged to the upward trend. So I'd be giving this one the benefit of the doubt at this point. There's, just like with the stock market, turning points generally take more than a few days to develop. So at this stage, this to me just looks like a pullback. There's not enough here to say there's a major turn going on. There hasn't really been a structural change. The averages they are turning a touch, but they're broadly been increasing. Not a dip I want to buy, but if I had it, wide trailing stop, I'd give it a little bit longer. But like all stocks at the moment, particularly some of the ones which maybe have less earnings, could be more speculative money in them. I don't know anything about this stock. I'm just making some assumptions, but it can be worth being extra vigilant on your exit points. Just know where you're getting out, and if the time or when the time comes, because the time will come at some point, just be ready.
All right. The next one, PWN. I think we did this one, did we?
No,
PRN. We did PRN. PWN.
This is a 1.6 cent stock. So look, this isn't going to be one for me. But having said that, if you like it for some reason, and there's all sorts of reasons to like stocks, we have the makings of an upward trend. It's above rising moving averages. It's recently broken above those highs from November, and it's doing so amidst a backdrop of falling stock prices. If someone wanted to play this and happy with taking on some risk, I think it needs like buying at current level. So you're kind of buying the breakout, but just being the nature of a 1.6 cent stock, it doesn't take much to rack up a big percentage move. The stop loss would be like 35% away, I think, for me, getting it back below, having a stop below the 100-day moving average. So if I'd already bought that breakout, if I bought the break, the rebound off the moving averages and the break above the November high, I'd be happy to hang on, have my stop loss, trailing stop below the 100-day moving average, see what happens. It's not one which I'm going to consider, but I can see how there's a play here for someone who is interested in this stock. And you never know. Sometimes these smaller ones, they fly and you can make a lot of money. That's why it's like, don't cap your upside, let it go as far as it can, have your your risk management with a trailing stop.
All right. Next one's from Jason from one of her favourite motion trader stocks, which is KOV. You want to hold, buy more, or sell?
Yes, I've got some, and at the moment I'm doing neither, not buying, not selling, just holding. But yeah, there's possible structural change going on. You can see these moving averages turning and prices below it. It's not like we haven't seen this before. We had we looked at it back here in October, it would have been, well, okay, the moving averages turning were below the averages. Let's just keep an eye on this, and we could go back to May 23. Yeah, the same thing. I had this stock. I've had this stock since back in, I don't know when, 22 or something, maybe 21. I don't know. I had it for a long time because it's stating that this in a big trend. I've given it plenty of room to move around. And it will have these times where it could be moving into where it is becoming vulnerable, but vulnerability doesn't mean that it's going to break down. It just means keep an eye on it. It's the structure has shifted from being above moving averages to being below. So time to watch it. What's going to happen here? It could stabilise here again and start moving higher. But I don't want to buy this dip, especially in the current environment. And I also don't like buying dips below the moving averages. I'd rather buy maybe it moves into another sideways period like it did during 2022, in which case it was, it's like I'd be interested in maybe buying a breakout, but I don't want to buy dips below moving averages. When we just compress this a bit, you can see how I've been able to hold this stock for some time. Maybe my entry point could have been, I'm just looking at the chart, could have been around July 21. And this is what you can do with a wide trailing stop: is pay dividends through this period. It hasn't gone up tenfold or anything like that, but it's up about 100%. I've got dividends. It's just one of those nice steady players. It's not one of the superstars. It's just a steady player in the portfolio. It's been there for a number of years, and I'm happy to keep holding at this point in time until it comes back to that trailing stop.
All right, fantastic. Thanks, Jace. We've got a question here from Chris around what ETFs there are for shorting stocks on the ASX. Now, that said, do you know of any? Number one. Number two, we're wanting to look at BOZ and B Bear. They could be the ones, and that's from another.
So you just do a Google search, ASX Bear ETF, and you'll get a few ones. BBOZ is a leveraged ETF, so I think they work on about, if the market moves 1%, this should move somewhere between 2 and 2.5%. So it's got a bit of leverage to it. I have traded in and out of this one in the past, but I find them difficult. The same question came up in the strategy session, my strategy session on Friday. I find them difficult because, with the exception of COVID, where you got this really big move, most of the time, by the time people think of putting them on, the move is almost over, and then it starts giving back. So I find them difficult. You're not going to the time to buy them is when the market's at a high. But why are you going to do that? Because when the market's at a high, we let something that's working keep working. So then you've got to start picking tops, and I think that's a losing game because often the market runs over the top of you. So this goes back to 2015. So you can see if you're a buy and hold being short the market, it's been a disaster. It's down 99% or something probably. So I find them difficult. So we can say, look, I'm a bit nervous about the market now. I'm just going to get a few BBOZ, and maybe the market does come off a bit more, and then there's a strong rally overnight in the US. Maybe I'm just making stuff up in a couple of weeks, and then the market quickly gaps and it's trading, opens the next morning and it's trading at a lower level, and you've gone, oh, well, I was doing well, but now I've woken up this morning and it's opened up down here. And you can see that this chart is full of gaps because this doesn't trade 24 hours or near 24 hours like maybe a SPY future, which is the ASX 200, a futures contract on it. So you can sell, you can close your position overnight, or a CFD where you might be able to close it overnight. This is only active during trading hours, so that's why it's prone to these gaps either side. So it's you might say, look, I'm getting a bit nervous now, but then we look at this in a few months' time, and it's down at new lows. So the concept's good, hedging on the way down, but it's all about like how are you going to lift the hedge in a profitable way, or are you just having it in there as calamity insurance? And that can be argued as being a reasonable thing to do. Say, look, I'm just having it in there for calamity insurance in case the market falls 50% in 2 weeks. Probably not going to happen, but that's what insurance is for, is to insure you against outlying events. So I don't use it, but if someone wants to use it, do so, but just be aware they're not, I don't find it's a good, I think there are better ways to make money. It really is an insurance product, I think, not a money-making exercise.
All right, let's get back on our ticker, which is TLX. Company ticker.
Trend's still up. Trend's comfortably still up. If I had this, I'd be holding it. Wide trailing stop. I don't want to buy the dip back to the moving averages in this environment, as we've discussed. It's just let a stock which has been working continue working until it tells us it isn't. And at this point, nothing here says that this is about to stop working.
All right, good. That's an easy one. Yeah. I'll get down to a question around portfolio right at the end. I think we'll leave that one to the end. Let's get the momentum going. EOL.
Trend's up. This is a thinly traded stock. It's a stock that I had a signal to buy, and I didn't buy it because it was just so thinly traded. So well done to someone if they have actually managed to get through the thinness of this market. If I had got on, I'd be letting it run and just see what happens. It looks like it does probably need to consolidate. Like it is so stretched above those moving averages, but the trend is well and truly in place. Wide trailing stop, I'd be risking most of this move. And just see where it goes. Wide trailing stop, see what happens. Trend's up.
All right, good one there, James. Next one's from Kirby with ADT.
Well, this is holding up quite well in the current environment. We can just put in some overhead resistance. If I had this one, I'd continue holding it. If I didn't have it, I wouldn't buy it just at the moment. Not with it in the current conditions, and also we've got this resistance just above. This is probably a breakout play for me. If it were to break higher, maybe if it were to get up to around 456 or something, it could be a buy. But I'd just be hesitant as I keep saying, in this current environment. But looking at this on its own merits, consolidating along the moving averages, if it can rally off the averages, break above resistance, it's a buying setup. So if I had it, I'd be holding it. If I didn't have it, watch for the breakout. But it's an interesting one. I do like that it has been able to hold itself together despite the selling we've had.
All right, next one is TNE.
Trend's still in place. It's at this point, like it's been a really big trend. At some point it'll go through a big consolidation. Maybe it's approaching that, but we just don't know. There's maybe it's a range forming. We could get some sideways price action. So it's not. I don't think there's any hurry to go in and buy this stock. But if I had it, I'd keep holding it. I had my trailing stop below the 100-day moving average, and I'd be prepared to say, look, this stock could get messy for a while because it has had that big trending phase. It's up nearly 100% since since May last year. So in under a year, it's up around 100%. And it's a larger stock too. So I think there's every reason to believe this is we could be going into a messier consolidation phase. But it can emerge from that and continue in an upward trend, as we saw after this lengthy consolidation. Big moves often lead to big consolidation. So it's a big move. We could get a lengthier consolidation, but that trend does remain up. So I wouldn't be in a hurry to be running for the exits. Instead, I'd be using my wide trailing stop.
All right, fantastic. I think that's the end of the tickers for today, Jace. We'll finish off on this one question here, just comparing, I guess, your portfolio to Rose's. My portfolio is down 7%, and as stocks have hit their stop losses, I've moved to about 15% cash. I'm wondering if these are similar to Motion Trader portfolio.
Down about 6%. My portfolio is probably down about 6% from its peak. And you can see my portfolio on the Motion Trader website, because I have it up there. And yeah, look, it's not unusual. It depends what sort of stocks you own, of course. But a 6% drawdown, particularly if you're in medium to smaller stocks as well. I'm just going to see what's the All Ordinaries down. Well, the All Ordinary, or the ASX 200 is down 6%. So if you're down 6%, you're down the same as the market. So that's completely normal. In a bear market, like I've had pullbacks of 15 to 20%. This in a bear market, and that will happen. We will get a bear market at some point, and there'll be a larger drawdown. When you trade individual stocks or actively invest in individual stocks in the stock market, there are going to be those bigger drawdowns at times, but hopefully they're compensated for by strong returns during the trending periods. I'm doing something similar. I've been increasing cash. We've spoken about that, and I know I'm going to get these drawdowns of every year. I'm going to get drawdowns of say 5 to 7%, maybe 10%. Every couple of years, there could be 15%. Every maybe 3 or 4 years, maybe I see a 20% in there. It's just like the stock market itself. When we get a big drawdown in the stock market, it will naturally flow through to people's portfolios as well. And that's the price we pay when we sign up to play the stock market, that we know drawdowns are in the future, and some of those drawdowns will be unpleasant. That's the price of admission. You've got to go in with this, with the eyes open. You've got to know that's going to happen. We can say, we'll talk all about protecting capital and everything, and that's what we do, but you're still going to get the drawdowns because the market moves around. We can't just pinpoint our exits so we never lose any capital. You don't want to lose capital. The stock market's not the place. So, and I'm sure our viewer knows that as well. So that's all good. So at the moment, 6% seems reasonable.
All right, fantastic. Well, thank you very much again for today, Jason. Thank you very much, everyone, for coming along and sending us your wonderful questions and your ticker examples there. Don't forget that whatever we do or say on this is general advice only. Please do your own research. You may have your own reasons for entering or exiting your stock, obviously, so make sure you do your own diligence around that, make your own decisions. The other thing is, don't forget to go and just check out Jason at motiontrader.com.au. If you'd like to see what Selfwealth's about, you can ask me any questions. Come to selfwealth.com.au there. All right. Don't forget to like and subscribe as usual. Thank you very much, everyone, for another wonderful week. Once again, let's hope it turns around. But if not, we'll be prepared for next week. Jace, have a good week ahead.
Well, that's right, Rog. We've got a plan for everything. Market goes up, there's a plan. If it goes down, there's a plan. If it goes sideways, there's a plan. And that's the thing. Now we've got the plan. The next step is to follow the plan. Exactly. Come what may. So let's reconvene next week and go through what new developments we have in the price action. That's been fun. Thank you, Rog. Thank you very much for joining us.
Thank you, everyone, and have a great week ahead. Take care. Bye-bye.